Welcome to Datta Finance. All right, today we're tackling a really big and, honestly, a pretty controversial idea in personal finance. It's a concept that basically flips everything you've ever been taught about money right on its head. So let's just dive right in. Okay, let's just put it right out there. Savers are losers. That's a direct quote from Robert Kiyosaki, the author of Rich Dad, Poor Dad. And when you first hear that, it just sounds wrong, doesn't it? I mean, everything we're ever told is to save our money. Get a good job, be responsible, put a little bit away each month. But what if, and this is a big what if that very advice is actually making you poor?
And that's the big question, right? It's a totally fair question. How on earth can doing the one thing everyone says is responsible actually be a losing game? Well, to get to the bottom of this, we've got to look at what that stuff in your bank account really is.
So that brings us to our first section. We're going to break down exactly why your cash might as well be, well, trash. We're talking about these invisible forces that are silently chipping away at your savings, even when you think it's all safe and sound in the bank. Okay, so to really get why your cash is losing value, you have to understand this one crucial distinction, the difference between money and currency. They sound the same, but they're not. See, before 1971, the US dollar was actual money. It was tied to gold, a real thing, a tangible asset that held its value. But ever since we went off the gold standard, the dollar became currency. And what's currency? It's just a tool for exchange that governments can print more and more of whenever they feel like it. And trust me, they do. So here's where the rubber meets the road. Let's say you've got a high-yield savings account and you're getting, 4% interest. Sounds great, right? You think you're making money. But what if inflation is running at 7%? Well, do the math. Your purchasing power, what your money can actually buy, is actually going down by 3% every single year. It's like you're on a treadmill running as fast as you can, but someone is slowly tilting it backward. You're losing ground without even realizing it. And this is the real gut punch. Think about it. Every single hour you work, every dollar you manage to put away, you're trading your precious, valuable time for an asset that is literally designed to go down in value. The poor dad mindset is all about saving that currency. But the rich dad mindset, it's about using that currency to buy real assets that go up in value. Okay, so if just holding on to cash is a losing game, what are you supposed to do? Well, this brings us to another huge concept from Rich Dad, learning the difference between good debt and bad debt. Yep, you heard me. Good debt. Look, for most of us, the word debt is a four-letter word. It's scary. But for people who understand money, it's just a tool. So what's the difference? Bad debt is the stuff that makes you poorer. It's when you borrow money for liabilities. A new car, fancy clothes, that big screen TV. You have to work harder to pay that back. But good debt, that's a whole different story. That's when you borrow money to buy an asset that makes you money, like a rental property. In that case, guess who pays off your loan? Your tenant does. And ideally, you're making a little cash flow on top of that every month. All right, now let's put these pieces together. This is where it gets really interesting, because we're going to look at how this all builds into an incredibly powerful strategy for building wealth. We're moving past the theory and into a real step-by-step game plan for putting that good debt to work for you. This is a strategy called the velocity of money. The whole idea is, instead of saving up for like 20 years to buy one house with cash, you use leverage to speed things up dramatically. So let's just walk through a quick example. Step 1, you take 50 grand and use it as a down payment to get a loan for a $250,000 house. So now you control a $250,000 asset. Step 2, a few years go by. Inflation does its thing, rents go up, and now that property is worth $300,000. You just built $50K in equity. Step 3, this is the magic part. You do what's called a cash out refinance. You pull that new $50K of equity out as pure cash. And the best part, because it's a loan, it's tax-free. And step 4, you take that 50 grand and use it for down payments on 2 more properties. Just like that, you've turned 1 property into 3, and you didn't have to save a single extra penny. But hang on. Before you run off to the bank, there is a huge critical warning here. This strategy, it's like a finely tuned race car. It can get you where you want to go incredibly fast, but if you don't know how to drive it, you're going to crash, and you're going to crash hard. The risk isn't the debt. The real risk is being uneducated. So before you even think about trying something like this, you have to know the fundamentals inside and out. Things like debt coverage ratios. Does the rent you're collecting easily cover the mortgage and all the other expenses with room to spare? What about market cycles? Are you buying at the very top of a hot market right before a crash? And probably the most important thing, cash reserves. Do you have cash on hand for when the AC breaks or a tenant moves out unexpectedly? Because things will go wrong. This strategy isn't about having zero cash. A solid emergency fund is absolutely non-negotiable. The whole point is to be a smart, educated investor, not just a reckless gambler.
Okay, let's bring this all home. What we've been talking about isn't just a clever financial trick. It's way bigger than that. It's about a complete shift in how you see the world, a shift from being a passive saver to becoming an active investor. You know, the core difference really boils down to one simple question. Are you going to spend your life working for money, or are you going to have money work for you? Are you working for currency that's losing value day by day, or are you using that currency to buy assets that pay you while you sleep? It sounds simple, but that choice right there will define your entire financial future. So, if this explainer made you think a little differently about that money sitting in your savings account, do me a favor and hit that like button. Make sure you subscribe for more breakdowns on all the money stuff they should have taught us in school but didn't. And hey, if you know someone who's still convinced that stashing cash is the only path to wealth, share this with them. Thanks for tuning in.